All right, you have an exciting topic. This is kind of the biggest topic in the last few weeks, and
That's right.
so yeah, interested to hear your perspective. Uh,
Yes,
so it's so yeah, it's Taariq from Volume Finance. You're the head of marketing, BizDev, I think, community.
that's right. That's right.
Okay.
Thanks so much, Jen. And am I free to go? All right, I guess I am. So, greetings, everyone. And my name is Taariq Lewis, and I'm the founder of Volume.Finance. My topic of discussion today is the collapse of Luna and UST, a post-mortem analysis. I just want to say before we start, thank you very much to Jun Nam, the entire WCF team, for inviting me to speak today. And I want to say also thanks to all the prior speakers. I saw some of the most amazing presentations, just very, very good work and very smart folks. Thank you as well. And of course, to those listening now here at there towards the end of the day, I hope I don't keep you put you too much to sleep, but I hope this is interesting. My topic today is the collapse of Luna and UST, a post-mortem analysis. Question is, insights and perspectives on the collapse of UST and Luna. I start first with the conclusion. Ladies and gentlemen, I am like you. I did lose a lot of money when UST imploded on Terra, and the network was essentially shut down and forked into Terra Classic and now New Terra. I was hurt, and I am still recovering from the entire event, even our company. But I have a conclusion I wish to share with you. That may seem a little bit counterintuitive. My view is that we need more algorithmic stable coins in looking back or in light of what happened with Terra and UST. And let's talk about how we build from here. Okay. So we start with the premise that juiced stablecoins attract hodlers. It causes some trouble. So let's start. What is a hodler? A hodler is somebody, or hodler, depending on your preference, somebody who holds their cryptocurrency for savings. We know you Bitcoin people out there. And whether you're a retail or institution, you want to preserve the value of your currency. You want to be able to store it somewhere. And as well, if someone said to you that they would pay you for storing it with them, you would be attracted to their payment. You would be attracted to that rate. Again, whether you're institutional or retail, you want to be paid to save. However, you still want your money back. You still want to make sure that you get it back and that what you put in, you get out. So what did Anchor do? And what is Anchor? The Anchor protocol was a protocol built on top of the Terra blockchain. And Anchor was an amazing invention. It was a success, massively a success. How big? It got people to save. Hey, it got me to save. Mom, I saved. But it paid 20%. Imagine a stable coin at the Crypto Olympics on steroids. Yeah, it would get disqualified. Anchor was a cryptocurrency, a crypto protocol that juiced its savers with 20%. And even though it was too good to be true, $14 billion of savers' money was there at the peak, all the way up to the first week of May of 2022. So, well, what happened because of this marvelous success? Well, I'll go on to my second piece to say that these juiced USD savings, where people were being juiced 20% returns for putting in a savings, failed to generate juiced borrowing. Imagine it was as if somebody had blown up a balloon on one side, put it in the middle, tied it off on the other side of the balloon. Nothing was there. Terra dApps, so decentralized applications on the Terra blockchain, did not drive demand for Luna, which was the other side of UST. Over $1 billion of OTC Luna purchases did not move the Luna price that much. I mean, yeah, we went up to $60 per Luna, but even those OTC sales were done at a discount. Why didn't we do things like burn Luna on excess to create demand? Why? Maybe Terra governance was slow. Who knows? But the point is that Luna, which was burned to generate UST, could not keep up with the market cap of UST that was growing by those people who were attracted to the juice. The ecosystem for Luna token was simply not enough. Once the disparity became evident to savvy market players, it was easy for somebody to just say, maybe UST is not worth $1. Maybe we should short it, which is what happened. Sophisticated market players decided to short. What is it? They borrowed to sell. They sell and said, listen, I think I'll sell this. I bet the price is going down. How can you have faith in one UST when you think it's impossible? And as a result of the failure to get borrowing to keep up with lending, we all know what happened. The peg broke, could not sustain $1. Luna essentially was minted into trillions. The market, the network halted, and of course, UST failed. And you and me, we lost money. So can we make algorithmic stablecoins better? My last topic, question. Well, while everybody is saying, no, we should run away, and we see now legislation from both Europe and the US saying, legislate these things, make them licensed, do away with them, I say we can make them better. I say that we should make them better because algorithmic stablecoins may hold a promise for freedom. Let's talk about how that might look today. And I'll do it by talking with a case study. Okay, I'm going to talk about the case study of Reflexer's Rye. All right, so if you don't know about Reflexer's Rye, take a moment right now, fire up that laptop, and Google, what is Reflexer's Rye? Well, Rye was co-founded by a certain gentleman that we want to talk about, Amin. Shout out to Amin. Hey, Amin, are you watching this? Now, if you don't know Amin, you must remember Spank Chain. You did not remember Spank Chain? Oh man, that was anyway. Spank Chain founder Amin was a co-founder of Rye, and ironically, he may be the savior of our seeking decentralized algorithmic stablecoins. So I'll talk a little bit more Rye here. Rye is a decentralized algorithmic stablecoin based on DAI. I'm sure many of us know DAI, and remember DAI was first based on ETH. So the co-founders of Rye read the DAI purple paper, which said that an algorithmic or decentralized algorithmic stablecoin shouldn't be pegged to anything, not even $1. But if it wasn't pegged to anything, could it float? And could it float in a stable manner? So Rye aims for floating stability, not based on the dollar, and not based on juicing borrowing. And Rye, not being pegged to any US dollar or any other currency, is its own stable currency. Now, don't believe me for these claims. Vitalik just recently mentioned that when he thought about the future of stablecoins, he thought Rye was a model that we should look at, which was one of the main reasons why I continue to look at Rye. And well, let's talk about why is it working then? What is the core of Rye as we sort of think through this? Well, we know Rye does not incentivize savings. It doesn't juice it. It's not a crypto stable on steroids. The way Rye is done is you would bring or essentially take your ETH and just like DAI, put it in a safe, lock it up by about 200%, and then mint this token called Rye. The Rye protocol, the reflexive protocol Rye, would then essentially adjust the price of Rye or the redemption price based on demand for the Rye token. So if suddenly ETH went up and suddenly one could get or mint more Rye, you would be able to use now or adjust. The system would automatically adjust itself so that the Rye price would come back to a certain stable layer. Rye's performance to date. This is not like a multi-billion-dollar project, but it's interesting. Go to coinmarketcap.com and look for Reflexer Rye. Check out the price. It looks like a heartbeat AKG. But what's interesting is that even during the pandemonium from May 9th all the way to date, Rye's floating price has gone up and down pretty much as it has for the past year. Unlike UST, USDT, which we've seen many broke peg and struggle to regain. You won't see billions in volumes, but you will see something that is an example of a resilient algorithmic stablecoin. Something that is free from being chained to the US dollar, and something that is stable enough to allow users to get back more or less of what they put in. We think RAI is interesting as the future for better algorithmic stablecoins. Who are we? We're Volume.Finance. And why are we here? We at Volume.Finance want to see more algorithmic stablecoins be built. I'll get it right. We want to see more decentralized money, and we want to see people really be free from having to be pegged to anything or any other currency. So come talk to us. Meet us at Volume.Finance. We're also on Twitter, twitter.com/VolumeFi. And tell us what you think about algorithmic stablecoins, or bring your algorithmic stablecoins project with us. We'd love to help you get them launched. And we think there are more algorithmic stablecoins coming. Thanks so much for listening. It was a pleasure to be here. Thank you, Jun, and the WCEF team. Have a good night.
Hey, thanks so much, Taariq. Really engaging talk. So appreciate that. And yeah, feel free to stick around if there's any questions from people. We have a DeFi panel coming up, and we should go backstage real quick to kind of set up here. So really appreciate it. Thanks, Taariq.
It was awesome, Jun. Thank you so much. Pleasure. All right.